Welcome to the deep dive. Our mission today, well, it's to tackle this huge stack of complex source material we've gathered.
Yeah, it covers a lot of ground.
Everything from, individual property contracts, financial loopholes, all the way up to high stakes urban policy and even sales psychology.
Mm.
And we want to synthesize all of that into actionable, well-informed knowledge for you, the learner.
Right. We're not just here to list definitions.
Mm-hmm.
We're aiming to connect the dots
Connect the dots how?
between the micro level stuff,
Yeah.
the mechanics of signing a single deal,
Mm.
and those big macro forces. History, finance, technology, all the things that really determine if that deal succeeds or fails, maybe 10, 20 years down the line.
Ah, okay. So understanding the whole ecosystem.
Exactly.
Yeah, because the person who really excels in real estate, they're not just good at, say, the math or just good with people.
Well, more than that.
They have to know how these fields, which seem pretty separate, actually interact.
That's the key.
So today we're looking for those surprising connections. We'll go from the nitty-gritty details of due diligence and tax strategy right up to how maybe exclusionary zoning policies from 70 years ago are still affecting your cap rate today.
It's all intertwined.
Let's jump right in then, at the sharp end. The financial discipline you need for every single transaction.
Okay, so the first, maybe the most fundamental rule from our sources.
Yeah.
You absolutely have to treat financing as a non-negotiable part of the contract,
Non-negotiable, meaning?
meaning you cannot leave it to a handshake or some vague verbal promise. It just won't fly.
Right, so every single term, the interest rate, the loan amount, any conditions at all, has to be explicitly written into that purchase agreement.
Correct. The sale is made subject to you, the buyer, obtaining financing that's acceptable.
And why is that specific legal structure so critical? What does it really do for the buyer?
Well, it creates this huge safety buffer. First, the obvious one. If the bank suddenly pulls back and the financing collapses, you can walk away
You can get your deposit back.
and get your earnest money deposit back, crucially. But maybe more strategically, it shifts some of the pressure.
Onto the seller and their agent.
Exactly. If the broker's commission depends on the sale actually closing, well, now they have a real vested interest in helping you secure that loan.
Ah, so they might even help you find a lender.
Sometimes, yeah. They might connect you with lenders they know and trust. It really changes the dynamic.
That totally reframes the negotiation. You're not just sitting there hoping the bank says yes.
You've made the seller's success contingent on your lender's approval.
And the sources mention this interesting loophole within that contingency, the part about acceptable financing.
Yes, that's often overlooked, but it's powerful. The clause says you can back out if the financing isn't acceptable to you.
Okay, so it's subjective.
Precisely. So let's say late in the due diligence phase, you find something unsettling. Maybe the inspection turns up more deferred maintenance than you expected.
Or the appraisal comes in low.
Right. Or the bank appraisal disappoints.
Yeah.
You can potentially leverage that acceptable financing clause as one last escape hatch if you're feeling genuinely uncomfortable about the deal.
A safety net.
It's a necessary safety net against buyer's remorse, especially when you're talking about, $500,000 commitments or more. It gives you that final moment to pause.
Okay, so contract secured, financing contingency in place. Now we shift from process to actually analyzing the deal's performance. We need quick screening tools.
Mm-hmm.
And the classic one, though maybe sometimes misused, is the 50% rule for rentals.
Ah, the 50% rule. Yeah, it's really just a rapid-fire screening filter.
How does it work, basically?
It's a rough assumption.
Yeah.
Assume that 50% of your gross potential rent, the maximum rent you could possibly collect, will get eaten up by operating expenses.
Okay, but before debt service.
Yes, crucially, before you factor in your mortgage payment.
Yeah.
So if a property doesn't look even vaguely promising under that quick 50% estimate, you just toss aside and move on.
Protects your time.
Exactly. It's about efficiency at the initial screening stage.
But the sources are pretty insistent this rule needs a big warning label. Why is that 50% figure so shaky in the real world?
Because that actual operating expense ratio, it can swing wildly. I mean, anywhere from maybe 30% on the low end up to 70% or even more in some cases.
70%. Wow. What drives it that high?
Well, think about property taxes. If you buy in a high tax area, that's a huge chunk right there. Or insurance. If you're in a coastal flood zone or a hurricane-prone area, your premiums can be massive.
Non-negotiable costs.
Totally non-negotiable. And those alone can push your ratio way above 50%. Then there's the age of the property.
Maintenance and CapEx.
Right. Older properties mean more maintenance. Plus, you should be setting aside reserves for big future replacements, roofs, HVAC systems, things like that, capital expenditures, or CapEx.
Which people often forget to budget for, realistically.
Very often. And if you factor those in properly, especially on an older building, you could easily hit 60%, 65% operating expenses right off the bat.
So the takeaway is, use the 50% rule to quickly say no, but never to say yes without digging deeper.
You got it. You absolutely must run the actual numbers, get real quotes for taxes and insurance, estimate maintenance realistically on any property that makes the first cut.
Okay. So if a property does seem worth a deeper look after that initial screen, we move to more established financial ratios, starting with a market-driven one, the gross rent multiplier, GRM,
Yeah, GRM. Simple. Property price divided by its gross annual income.
and its use for comparison.
Exactly. It's a fast comparative tool within a specific market.
Yeah.
If, say, all the comparable duplexes in a particular neighborhood are selling at a GRM of 8, and you find one listed with a GRM of 12,
Red flag.
big red flag. It tells you immediately the asking price is likely way out of whack compared to the local market average. You need to adjust your offer significantly or probably just walk away.
But like the 50% rule, GRM ignores all the expenses.
Correct. It's purely based on gross income. So to understand the actual performance, you need to calculate the net operating income, or NOI.
NOI, which is gross income minus all operating expenses, but still before debt service.
Right. And that NOI figure feeds directly into the really core valuation metrics, the net income multiplier, NIM, and its reciprocal, the capitalization rate, or cap rate.
Okay, break this down.
The cap rate is probably more commonly discussed. It's simply NOI divided by the property price. It represents the unlevered rate of return.
And the NIM?
NIM is just the inverse, price divided by NOI. It tells you how much an investor in that market is willing to pay for each dollar of net operating income the property generates.
So if a property generates, say, $10,000 in NOI and the market NA is 10.
Then the implied market value is $100,000. These metrics, cap rate and NIM, they're fundamental for valuation based on actual income performance.
Got it. And then, crucially, especially when you're dealing with lenders, there's the debt coverage ratio, or DCR.
Ah, yes. DCR. This one's critical for financing. It's your net operating income, NOI, divided by your annual debt service, ADS, basically, your total mortgage payments for the year.
So if I'm looking at a deal, what DCR number should make me nervous, and what should I be aiming for?
The absolute danger zone is anything at or below 1.00.
Meaning?
A DCR of 1.0 means your property's income exactly covers the mortgage payments. There is zero cash flow left over.
Which sounds bad.
It's terrible for an investor. The first time you have even a minor unexpected repair or a vacancy for a month, you're immediately feeding the property out of your own pocket. It's path to insolvency.
So what do lenders typically require?
Most commercial lenders,
Mm-hmm.
they want to see a DCR of at least 1.20, sometimes 1.25 or higher, depending on the property type and risk.
So the income needs to be 20-25% higher than the debt payments.
Right. That 20-25% buffer provides a cushion for vacancies, unexpected repairs, things like that. So if your own analysis, your pro forma, shows a DCR of only a 1.05,
Huge red flag.
massive red flag. You are skating on incredibly thin ice, one vacancy, one broken water heater, and you're losing money every single month.
It's fascinating, actually, to connect these individual property metrics, DCR, NOI, to the massive meltdown we saw in 2008. That whole crisis was fundamentally about real estate, right?
Right.
Built on layers of leverage and risk nobody fully understood.
Absolutely. It really stemmed from those low-quality, subprime mortgages. Our sources call them crappy triple B bonds.
Okay.
These risky mortgages were bundled together into mortgage-backed securities, MBS standard practice, sort of.
But they didn't stop there.
No. The investment banks got creative, maybe too creative. They took the riskiest pieces, the tranches of these MBS bundles, the parts most likely to default, and repackaged them into even more complex derivative products.
Collateralized debt obligations, CDOs.
Exactly. CDOs, and then sometimes CDOs based on other CDOs, layers upon layers.
So they were essentially slicing and dicing toxic debt. How on earth did they sell these incredibly risky things to, like pension funds or conservative institutions that needed safe returns?
Through financial engineering, basically.
Right.
Something called tranching. They structured the way cash flowed through these CDOs. The safest slice, the senior tranche, was designed to get paid first from the mortgage payments coming in.
Okay.
Because it had priority and seemed protected by the layers below it, the rating agencies, Moody's, S&P, were somehow convinced to give these top tranches a AAA rating,
The gold standard of safety.
the gold standard. Even though the underlying mortgages, the foundation of the whole structure, were increasingly shaky subprime loans.
And the whole system incentivized bad behavior.
Immensely. There was just so much money to be made. Lenders were incentivized to originate terrible loans because they could immediately sell them off to Wall Street to be packaged. The banks made fortunes creating and selling these supposedly riskless AAA products.
And they hid the risk.
Often, yeah.
Hmm.
They used off-balance sheet vehicles, complex accounting. It made the true scale of the risk almost invisible until it all imploded. Greed on all sides, channeled by a system that obscured the danger.
So the lesson for the individual real estate investor today isn't necessarily that you need to understand credit default swaps,
No, not at all.
but that you absolutely must respect leverage and understand layered risk even at your own smaller scale.
Precisely. Whether you're using, say, a 75% loan to value on a single rental property, or you're a Wall Street bank dealing with complex derivatives built on derivatives. The core principle is identical.
Which is?
The more layers of debt you add and the more complex the structure becomes, the higher the exponential risk of a catastrophic failure if the underlying asset, that single property or those thousands of mortgages, stops performing as expected. Leverage magnifies both gains and, much more dangerously, losses. Hashtag tag 1.2 tax strategy and wealth building.
Okay, let's shift gears to something a bit more rewarding, hopefully. Tax strategy. Real estate investors get some pretty phenomenal advantages here, starting with depreciation.
Depreciation. It's often called a phantom expense or a ghost expense.
Oh, I phantom?
Because it's a deduction you get to take against your rental income each year, representing the property theoretically wearing out. But you didn't actually spend any cash on that specific wear and tear in that year.
So it reduces your taxable income without reducing your cash flow for that year.
Exactly. It's a key tool for lowering your annual tax bill. However, you need to understand what happens when you eventually sell the property. And that involves understanding your adjusted basis.
Right. Let's use the example from the sources to make this really clear. Say you buy a property for $100,000.
Right.
And over, say, 10 years, you claim $20,000 in total depreciation deductions. What's your basis now?
Your original cost basis was $100,000. You subtract the $20,000 in depreciation you claimed. So your adjusted basis is now $80,000.
Okay. So now, if you sell that property for $130,000, your taxable gain isn't just the $30,000 difference between the sale price and your original purchase price.
Correct. Your taxable gain is calculated as the sale price, $130,000, minus your adjusted basis, $80,000.
Which means a $50,000 taxable gain.
Exactly. That $20,000 of depreciation you benefited from over the years, by lowering your taxes annually, it gets recaptured and taxed when you sell.
But the overall benefit is still huge, right? You deferred paying taxes on that $20,000 for potentially many years.
Absolutely. You essentially got an interest-free loan from the government on those deferred tax dollars, and you enjoyed years of lower taxable income and potentially higher cash flow because of it.
And that concept of tax deferral leads us straight into the ultimate wealth compounding strategy for real estate investors, the 1031 exchange.
Yes, the Section 131 like-kind exchange. This allows you to sell an investment property and defer paying all the capital gains taxes, including that depreciation recapture tax, as long as you reinvest the proceeds into another like-kind investment property according to specific rules.
And the power here is just continuous compounding.
It's immense. Our sources have an example. Investor #1 uses 1041 exchanges repeatedly over, say, 25 years, constantly rolling their gains into bigger and better properties without paying taxes along the way.
Versus investor #2.
Investor #2 sells a property every few years, pays the significant capital gains taxes each time, and then reinvests only the remaining after-tax amount.
The difference must be huge over time.
The source material suggests investor #1, the 1031 user, could easily end up with over $1 million more in equity after 25 years, simply because they kept the government's share of the profits, those deferred taxes, working for them, compounding year after year.
And that's how serious fortunes are built in real estate, tax-deferred growth.
It's a cornerstone strategy.
But the IRS isn't exactly relaxed about the rules here. If you decide to use a 1031, you're suddenly under two very strict clocks.
Oh, incredibly strict. And the deadlines are rigidly enforced. Miss them by even one day, and the whole exchange fails.
Okay, what are the clocks?
Once you close the sale on the property, you're relinquishing the down leg. The first clock starts.
Yeah.
You have exactly 45 days to formally identify, in writing, the potential replacement properties you intend to buy.
45 days isn't much time to find and lock down a deal.
It's extremely tight, and you have to follow specific identification rules, like identifying no more than 3 properties, or properties whose total value doesn't exceed 200% of the relinquished property's value.
And the second clock.
You then have a total of 180 days, starting from the date you close on the first property, to actually close on the purchase of one or more of those identified replacement properties, the up leg.
So 6 months total to close.
Right, but that includes the initial 45 days for identification. If your identification period ends and the deal you identified falls through, you're in trouble.
Which means?
Which means experienced 31 investors always identify backup properties within that 45-day window. You need contingencies because deals fall apart.
And if you miss either deadline?
The exchange is busted. All those deferred capital gains taxes become immediately due for that tax year. It can be a massive, unexpected tax liability.
Okay. And then there's the ultimate sort of loophole, where this tax deferral can actually become tax avoidance. How does that work?
If the investor holds onto that final property, the one acquired through the last 1031 exchange, until they pass away, then, under current tax law, the deferred capital gains might effectively disappear forever. This is because of the step-up in basis rule.
Explain that.
When the property passes to the heirs, their cost basis isn't the original low basis the deceased owner had. It gets stepped up to the fair market value of the property at the time of the owner's death.
So all those years, maybe decades, of accumulated deferred capital gains,
they vanish. The heirs could potentially sell the property immediately after inheriting it and owe little to no capital gains tax because their basis is roughly equal to the current sale price.
Wow, that's a powerful incentive to hold property long term.
It's a major part of generational wealth transfer through real estate.
Now, it's also important to know when not to use a 1031, right?
Absolutely. A 1031 exchange only makes sense if you're selling a property for a gain, if you're selling at a loss.
You want to recognize that loss.
Exactly. There's no gain to defer, so the 1031 structure is inappropriate. In that situation, you typically just sell the property, take the capital loss, and use that loss to offset other capital gains or potentially even some ordinary income, which could lower your overall tax bill for the year.
Okay, good distinction. Now, one more potential tax trap, this one for people using retirement funds, specifically self-directed IRAs to buy real estate.
Yes, this is crucial. Many savvy investors roll over funds from an old 401k or traditional IRA into a self-directed IRA, which gives them the control to invest in alternative assets like real estate.
Which sounds great, owning property inside a tax-advantaged account. Where's the catch?
The catch, the trap, springs the moment you use leveraged borrowed money, a mortgage within that self-directed IRA to buy the property.
Why is leverage the problem?
Because the IRS draws a line. They understand the benefit of retirement accounts is tax-free or tax-deferred growth on your contributions and their earnings. They generally don't want you using borrowed money debt inside that tax-advantaged wrapper to turbocharge those returns even further using someone else's capital.
So they tax the portion of the profit generated by the debt.
Precisely. It's called the unrelated debt-financed income tax, or UDFI tax. The portion of the income or gain that's attributable to the debt financing is considered unrelated to the tax-exempt purpose of the IRA, and it gets taxed.
So using the sources example, if my self-directed IRA buys a property using 60% loan-to-value financing,
then roughly 60% of the net income generated by that property, whether it's annual cash flow or profit from an eventual sale, does not get the usual tax advantage treatment of the IRA.
it's taxed.
Yes, it's subject to UDFI tax rates, which can be quite high. Similar to trust tax rates, it requires separate tax filings and calculations.
So does this mean you should never use leverage inside a self-directed IRA for real estate?
Not necessarily. It just means you absolutely must factor the UDFI tax implications into your financial projections before you do the deal. You need to calculate if the expected returns, after accounting for the UDFI tax and the added complexity, still make sense compared to other investment options. Sometimes it does, sometimes it doesn't. It just needs careful planning with a knowledgeable CPA.
Okay, so we've covered the crucial financial underpinnings, the contracts, the taxes, but none of that matters if you can't actually execute the plan. And that brings us from pure math into the realm of human dynamics, sales, communication, building disciplined habits. Hashtag tag 2.1, the psychology of sales and communication.
Right. And whether you're, trying to sell a multi-million-dollar commercial property or just trying to convince a busy contractor to prioritize your repair job, success really hinges on clarity.
Clarity.
Yeah, we see this really strongly in the story brand framework and its mantra. If you confuse, you'll lose. Ambiguity is just lethal to getting people to take action.
So your message, whatever it is, needs to instantly define 3 key things.
Yes. Number 1, What does the customer or client or tenant actually want? Number 2, what specific problem are you solving for them? And number 3, what will their life look like after they engage with you or your service? It needs to be crystal clear.
And critically, the problem you solve isn't always just the obvious external one, like needing a bigger house.
No, often the more powerful motivator is the internal problem. The feeling, the frustration, the fear.
Like the Starbucks example from the sources.
Exactly. The external problem is simple, I need caffeine. But the internal problem might be I need to feel productive, or I need a small, affordable luxury, or I want to feel sophisticated.
And Starbucks frames its value around solving those internal feelings.
Precisely. Which allows them to charge, $5 for a coffee. They're perceived as offering greater value because they address that deeper internal need.
So a savvy real estate professional needs to do the same.
Absolutely. Don't just sell the house, the external solution. Sell the relief from the stress and uncertainty of moving, the internal solution. Frame your value around solving that feeling.
And people, they instinctively trust someone who seems to have a plan, right? It makes us feel safe when the path forward is clear.
Yeah, having a clear plan is huge for building trust. Customers trust a guide who knows the way.
And these plans should be simple.
Very simple, highly visible, easy to understand, ideally no more than, say, 4 steps. You might use a process plan like Step 1, consultation. Step 2, identify properties. Step 3, contract negotiation. Step 4, closing. That relieves confusion.
Or an agreement plan.
Or an agreement plan to address fears. This lists the promises you make. We promise weekly communication. We promise transparent pricing. We promise to handle all the paperwork. Again, maybe 3 or 4 key promises. Simplicity builds confidence.
This really aligns with the philosophy in brokerage models like ninja selling. They emphasize it's not just about being smart or competent.
No, the relationship is key.
People prefer to do business with someone they know, like, trust, and are in flow with.
That's the mantra.
Uh-huh.
No, like trust, flow. And being a ninja, a top performer, requires being strong in all 4 dimensions.
So you could be incredibly trustworthy, super ethical, know your stuff.
But if you're cold, distant, hard to connect with, you miss the like factor. People won't feel comfortable.
Or you could be super charismatic and likable.
But if you're disorganized, miss deadlines, seem sloppy, you erode the trust factor, people won't rely on you.
So it's about balancing competence and connection.
You need both working together for truly professional execution.
Now, where communication often hits a wall, according to the sources, is when you're dealing with fundamentally different personality types, especially those diagonally opposed.
Ah, yes. This is the classic challenge. The example often used is the power person versus the peace person.
Describe them quickly.
The power person is typically very direct, decisive, focused on results, wants bullet points, hates small talk, moves fast. The peace person prioritizes harmony, avoids conflict, likes detailed information, wants reassurance, prefers collaboration, moves more deliberately.
And when they interact.
It can be oil and water if they don't adapt. If you're a peace-oriented agent dealing with a power client, you absolutely must consciously speed up your communication, get straight to the bottom line, focus on the result.
Or the power client gets impatient.
Exactly. They'll feel like you're wasting their time. Conversely, if you're a power agent working with a peace client, you need to slow down, provide more detail, offer reassurance, build consensus, check in frequently. Otherwise, the peace client will feel rushed, pressured, unheard, and the relationship will likely fracture. You have to adapt your style.
Okay, shifting to the actual negotiation process.
Yeah.
There are these core principles of persuasion, like the reciprocity rule.
Yes, the power of reciprocity. It's this deep-seated human instinct that when someone gives us something, especially unexpectedly, we feel an obligation to give something back.
An uninvited favor triggers indebtedness.
That's the idea. The source of material cites that classic study with the disabled American veterans. When they just sent out a standard donation request letter, they got about an 18% response rate. But when they included a small, unsolicited gift in the envelope, like those free personalized address labels,
The response rate jumped.
it nearly doubled to 35%. That small, unexpected gift created a feeling of obligation.
So how does that apply in real estate?
For investors, agents, anyone. It means proactively providing value first, without expecting an immediate return. Maybe send a potential client an insightful market report they didn't ask for. Introduce 2 contacts who could benefit each other. Offer some free advice based on your expertise.
Build goodwill.
Exactly. Create that sense of uninvited goodwill. It can make a huge difference later when you need to negotiate a tough point, or ask for a referral, or secure their business. That prior deposit in the relationship bank pays dividends.
But ultimately, a lot of negotiation, as the sources say. It just comes down to bare-knuckle bargaining over who gets which slice of the pie. It can be confrontational.
It often is, yes.
Right.
Especially over price or repairs or specific terms.
So how does a good professional manage the emotions, the clients, and maybe even their own during that stressful process?
By understanding and anticipating the emotional cycle of a transaction.
There's a cycle.
Pretty much always. It typically starts with excitement, we found the perfect house, or we got an offer. Then inevitably comes a phase of disappointment or anxiety.
The inspection report reveals problems. The appraisal is low. The buyer gets cold feet.
Exactly. Something almost always goes slightly wrong or at least causes stress. Then, if the deal holds together, you move towards the closing, which brings feelings of relief and finally happiness when it's all done.
So the pro anticipates the dip.
A good salesperson or agent anticipates that disappointment phase. They prepare the client for it before it happens. They normalize it. Okay, the inspection might find some things. That's normal. We'll deal with it.
So you're managing expectations.
You're managing expectations and emotional states just as much as you're managing the contract details. It smooths out the roller coaster ride for the client over that intense 30, 60, maybe 90-day period. Hashtag tag 2.2 systems, habits, and focus.
Right. And sustaining that level of execution, managing those emotions, closing those deals, it all comes down to discipline, which means building effective systems and habits.
And habits, as the sources point out, they're kind of a double-edged sword.
Very much so. Good habits make time your ally. Think about saving money or exercising or prospecting consistently. The longer you do them, the more the benefits compound. Time works for you.
But bad habit.
Bad habits make time your enemy. Procrastination, poor financial management, inconsistent effort. Time magnifies the negative consequences. It widens the gap between success and failure over the long run.
So that consistency is everything. Time is the ultimate multiplier. But how do you stay consistent, especially with goals like, say, financial independence, where the payoff might be decades away? It's hard to stay motivated. That's where you need systems that focus you on the process, not just the distant outcome. Habit tracking is surprisingly powerful here.
Just checking off boxes.
It sounds simple, but yes, visually tracking your progress, whether it's watching your investment portfolio grow or seeing a streak of days you made your prospecting calls, or logging the hours you spent researching deals, provides immediate positive feedback.
Give you a small win today.
Exactly. It provides that intrinsic satisfaction. It reinforces your identity. I'm the kind of person who does this consistently. And it keeps you focused and motivated, especially during those inevitable periods where the big results aren't showing up yet.
It also helps reframe the mental game around things like saving money, right? A lot of people see saving or investing as a sacrifice.
Yeah, that framing, saving means sacrifice. Living below my means feels restrictive. That's a huge mental barrier for many people.
So we need to flip the script.
We need to reframe it. Associate saving and investing not with sacrifice, but with freedom. Future options, peace of mind.
Because living below your current means
Directly increases your future means. It's a conscious trade-off. A little less consumption today for potentially a lot more freedom and security tomorrow. Consistency makes that trade incredibly worthwhile over time.
Now, to actually achieve big goals, you need focus. Trying to do too many things at once just leads to diffusion. Nothing gets done well.
Right, which is why some frameworks, like the one described in the 12-week year, are gaining traction.
So what's the core idea there?
It basically rejects traditional annual planning. You know how New Year's resolutions often fade by March?
Guilty.
Yeah. The 12-week year says treat every 12 weeks like a full year. It forces you to identify just the top 1, 2, maybe 3 critical goals that will have the biggest impact in the next 12 weeks.
And focus intensely on just those.
Intense focus. The shorter time frame creates urgency and makes accountability much more immediate. You don't have the luxury of putting things off until Q3 or Q4.
And when you inevitably feel overwhelmed, which happens to everyone trying to achieve big things,
the answer is almost never just work more hours. That usually leads to burnout and diminishing returns.
So the answer is
ruthless prioritization. You have to identify the single most important task you need to accomplish today, the one thing that will move the needle most significantly on your key goals.
And protect the time to do that one thing.
Protect that time fiercely. And, maybe just as importantly, consciously decide what not to do, except that some smaller, less critical things might slip. You might have to say no more often. You prioritize impact over just being busy.
Makes sense. And finally, tying all this planning and execution together is accountability.
Yes. The link between success and accountability, our sources say, is pretty much irrefutable.
But accountability often gets confused with blame,
Right? It does, but that's not what it means in a professional context. Accountability isn't about finding fault. It's about taking ownership of your role in the outcomes of both the wins and the losses.
Why is that ownership so important?
Because without acknowledging your role, you can't learn. If you blame external factors for every failure, you're powerless to change your process or improve your results next time. Owning the outcome allows you to diagnose what went wrong and implement changes.
And it extends to your commitments to others?
Critically, in a relationship-driven business like real estate, your word is your bond. Broken promises, missed commitments, they don't just cause frustration in the moment.
They destroy trust.
They fundamentally damage relationships and erode faith in your reliability. And that loss of trust can be absolutely lethal to your long-term success. Hashtag tag 2.3 landlord and property management execution.
Okay, let's bring this down to the ground level, managing rental properties effectively. Execution in the field. It starts even before you buy, right? With choosing the right kind of property.
Absolutely. The advice from the landlord-focused sources is really clear on this. If you want to attract good tenants, buy a well-designed house, preferably in a good, stable, mostly owner-occupied neighborhood.
Why owner-occupied?
Because you're essentially buying the neighbors along with the house. Quality tenants, the ones who pay on time, take care of the place, stay long-term. They value living near other people who also take pride in their homes and keep the neighborhood looking good.
And conversely, they warn against buying in areas that are already heavily saturated with rentals.
Yeah, the risk there is that if many other landlords in the immediate area are slumlords or just neglectful about maintenance and upkeep.
You potential tenants might assume that's the norm.
Exactly. The overall neighborhood quality might decline, attracting tenants who are less invested in maintaining the property or the community. That can lead to higher maintenance costs, more frequent turnover, and bigger headaches for you down the line.
Okay, so location and neighborhood quality are key for attracting good tenants. What about sourcing the deals themselves, especially looking at for sale by owners, FSBOs?
When screening FSBOs, the key is to figure out the seller's motivation. Don't waste your energy on sellers who just want to sell walk. Maybe they're testing the market, hoping for an unrealistic price, trying to avoid paying a commission.
Focus on the need to sell sellers.
Precisely. Look for sellers who have to sell due to a specific life event. They're being transferred for a job, they're getting divorced, they just had a baby and need more space, they inherited the property and live out of state.
Because high motivation means?
High motivation usually means they're more realistic about price and terms, and they're eager to get the deal done efficiently. You're much more likely to strike a reasonable deal quickly.
Okay, so you've bought the right property in the right neighborhood from a motivated seller. Now you need tenants. The sources say being a landlord is basically a sales job.
It really is.
Yeah.
You have to actively sell the property's benefits and features to good prospective tenants, convincing them it's the right place for them. But that sales job has to be paired with rigorous screening.
Non-negotiable screening standards.
Absolutely non-negotiable. You need to define your minimum qualification standards in writing before you even start marketing the property.
Like what?
Things like minimum income requirements often say 3 times the monthly rent, minimum credit score thresholds, clear policies on pets, smoking, number of occupants.
And then you verify everything.
You collect a deposit up front with the application. You verify their income sources, pay stubs, bank statements. You run thorough background checks and credit checks through a reputable service. You call previous landlords.
Diligence up front saves pain later.
Immense pain. Skipping proper screening because someone seems nice or you're in a hurry is one of the fastest ways to invite serious financial and legal nightmares into your life.
All right, now let's talk common mistakes landlords make in the day-to-day management. Our sources highlight ignoring timely maintenance as a huge one.
Oh, it's massive. And it's incredibly counterproductive. It creates this downward spiral.
How so?
Good tenants, the ones you want to keep, they expect reasonable and timely repairs. If the property manager, as the anecdote goes, literally has a drawer full of unaddressed work orders,
That good tenant is gone.
they are out of there the second their lease expires. And tenant turnover is incredibly expensive. You lose rent during the vacancy, you have make-ready costs, painting, cleaning, potentially leasing fees. It kills your profitability.
Plus, deferred maintenance usually gets worse, right?
Exponentially worse. That small roof leak you ignored for 6 months isn't a small leak anymore. Now it's a major mold remediation problem, potentially damaged drywall, maybe even structural issues. What could have been a few $100s is now thousands.
Okay, so proactive maintenance is key. What about dealing with problem tenants who aren't paying rent or are breaking other rules? Say they move in an unapproved roommate or they're constantly making noise.
When tenants violate the lease terms, you have to be firm, consistent, and follow the legal process precisely. You must enforce the rules.
Which means?
It means serving them with a formal, legal, written notice, usually called something like a notice to comply or vacate or a cure or quit notice.
So if they have an unauthorized pet.
The notice clearly states the lease violation, the pet, references the specific clause in the lease they're breaking, and gives them a legally defined time frame, maybe 3 days, maybe 10 days, depending on state law, to either get rid of the pet, cure the violation, or move out.
And most tenants will comply when faced with that.
Often, yes, especially for non-rent issues. Facing the very real prospect of eviction and the difficulty and expense of finding a new place to live, most tenants will choose to follow the rules rather than lose their housing over, say, an extra roommate or loud parties.
But eviction itself, that needs to be the absolute last resort.
Absolutely. Our sources stress this. Eviction is messy. It's expensive court costs, attorney fees, lost rent that you may never recover. It's incredibly stressful for everyone involved, including the landlord.
So try to resolve things first.
Always try to solve the problem outside of the formal eviction courts if possible, especially for non-payment of rent. Maybe you can negotiate a realistic payment plan. Maybe the tenant has lost their job and just needs a bit of time or help finding resources.
Or cash for keys.
Or offer cash for keys. You give them a modest amount of money to just move out quickly and peacefully, leaving the place in good condition, saving you the time and expense of a formal eviction.
But if those attempts fail,
Then you must act swiftly and follow the legal eviction process to the letter. Delaying only digs the hole deeper in terms of lost rent and potential property damage. Don't hesitate once it's clear negotiation isn't working.
okay, we've nailed down the mechanics of the deal, the financing, the management. Now let's zoom way out. Because the value, the context of any property you own or manage today is deeply rooted in decades of history, policy, and urban design choices, especially around residential segregation and zoning. Hashtag Type 3.1, the history of residential segregation and zoning.
Yeah, the sources really emphasize that in the United States, the single-family home became far more than just shelter. It evolved into this powerful, almost ideological symbol.
The American dream home.
Exactly. A paragon of middle-class aspiration, a visible sign of having arrived.
Yeah.
And crucially, the primary vehicle for ordinary families to build and invest wealth across generations.
There's that Walt Whitman quote the sources mention.
Right. A man is not a whole and complete man unless he owns a house and the ground it stands on. That really captures the deep cultural significance it took on.
And that powerful ideal directly shaped the physical form of American cities, leading to very low density compared to other developed nations.
Absolutely. Our dominant model of urbanism became the detached single-family house with its own lawn. Repeated over vast areas, this results in settlement densities far, far lower than you see in Europe or economically comparable countries in Asia, for instance.
And this wasn't just an organic preference. It was actively reinforced by government policy that led to de jure segregation by law and official practice.
Yes, the sources are quite clear on this. Local governments, often with federal encouragement, pushed exclusionary zoning ordinances.
How are they exclusionary?
They were designed specifically to reserve large areas, particularly desirable middle-class neighborhoods, exclusively for single-family homes, often with large minimum lot size requirements. This effectively priced out lower-income families who needed smaller homes or denser housing options, like apartments.
And there was often explicit racial intent behind these laws.
The sources state that yes, the racial intent was frequently open and undisguised, aimed at keeping minority groups out of these neighborhoods.
And the Federal Housing Administration, the FHA, which was created during the New Deal to stabilize the housing market and promote homeownership, it actually played a central role in enforcing this segregation.
It did, quite systemically.
Yep.
The FHA developed underwriting manuals and guidelines that essentially institutionalized racism in lending.
Redlining.
That was part of it, yes. Creating maps where entire neighborhoods, largely based on the presence of African Americans or other minority groups, were colored red and deemed ineligible for FHA mortgage insurance, effectively cutting off access to affordable financing.
But it went beyond just redlining maps.
Oh, yes. The FHA, according to the sources, frequently recommended and sometimes even demanded that racially restrictive covenants be placed in the property deeds for homes receiving FHA or VA mortgages.
What did these covenants do?
They were legal clauses written into the deed explicitly prohibiting the sale or occupancy of the property by anyone not of the Caucasian race. So the federal government itself was actively promoting and requiring instruments of racial segregation in housing across the country.
That official government endorsement lasted for quite a while, until the Supreme Court decision in Shelley v. Kramer in 1948. What exactly did that ruling do? It's
It-
been nuanced, right?
It's very important, but yes, nuanced. The Supreme Court did not actually rule that the restrictive covenants themselves were illegal as private agreements. Individuals could still technically write them into deeds.
So what did it rule?
It ruled that state courts, meaning the government, could not enforce these discriminatory private covenants. If a white homeowner tried to sue to block a sale to a black family based on a restrictive covenant, the state court could not uphold that covenant,
Because state enforcement would constitute state action promoting discrimination.
which violates the Equal Protection Clause of the 14th Amendment. So, while the covenants weren't technically illegal, the ruling stripped them of their teeth. They became largely unenforceable and thus useless.
Now, what's really striking is that the core economic argument the FHA used to justify all this, the idea that integrating neighborhoods, specifically with African Americans, would inevitably cause property values to decline. That was often just plain wrong, wasn't it?
Yeah, the source material points out that statistical evidence from the time often directly contradicted that assumption.
How so?
In many cities, when African-American families, particularly middle-class families, began moving into formerly all-white neighborhoods right on the edge of existing segregated areas, property values in those specific blocks often didn't fall. Sometimes they even increased.
Increased. Why would that happen? It seems counterintuitive given the prejudice of the time.
It wasn't because white buyers suddenly became welcoming. It was a direct result of the housing scarcity created by the FHA's own segregationist policies, like redlining and those restrictive covenants.
Ah, because those policies dramatically limited the supply of decent housing available to black families, even middle-class ones.
Exactly. The vast majority of new suburban developments and existing desirable neighborhoods were completely off-limits to them due to covenants and financing discrimination.
So the demand from the growing black middle class was funneled into a very small number of available areas.
Precisely. They faced intense competition for any decent single-family home they could legally buy, often in those transitional blocks near the existing ghettos. This concentrated demand meant they were often willing, and needed, to pay prices at or even above fair market value to secure stable housing.
So the FHA's policies created the very scarcity that drove up prices in those areas, disproving their own rationale.
It was a completely self-fulfilling and deeply discriminatory paradox. Hashtag tag tag 3.2, the modern city in digital transformation.
Okay, let's fast forward through the decades following those policies. We arrive at the modern city, which, according to some analysts cited in our sources, is facing a new urban crisis. What does that mean?
The new urban crisis refers to this growing gap, this widening inequality within cities themselves. It's the divide between the relatively advantaged urban elite, highly educated professionals concentrated in certain neighborhoods, and pretty much everyone else. The poor, the working class, even middle-class families who are increasingly struggling to afford city living.
And this is linked to a phenomenon called the Great Inversion.
Yes, that term describes the reversal of the decades-long trend of white flight to the suburbs. Starting around the late 90s and accelerating, we saw more affluent, often white, people moving back into central cities. They were drawn by jobs, shorter commutes, cultural amenities, a desire for density over suburban sprawl.
Okay, the affluent move back in. But the inversion implies something else is happening too.
Right. At the same time, poverty became increasingly suburbanized. A new population of suburban poor emerged. This group is largely made up of two components.
Who are they?
First, you have people, often minorities and immigrants, who are pushed out of gentrifying city neighborhoods by rising rents and home prices. They sought more affordable housing further out.
Okay. And the second group?
The second group are those who fell in place.
Fell in place, meaning they didn't move.
Exactly. These were often working class or lower middle class families already living in older or maybe less desirable suburbs. During economic downturns, especially the 2008 financial crisis, they experienced significant job losses or saw their home values plummet. They became poor or fell deeper into poverty without actually moving.
So the suburbs, once seen as uniformly middle-class havens, now have significant and growing pockets of concentrated poverty.
Yes, and often without the same density of social services, public transit, or job opportunities found in the urban core, making it harder for people to escape poverty there.
Now, that influx of affluent residents back into cities, combined with the historical preference for lower density, creates huge pressure on housing costs and intense resistance to building more housing, the whole in-me-boo phenomenon.
NNB, not in my backyard. It's a major obstacle to increasing density and affordability in high-demand cities. Existing homeowners often fight tooth and nail against new development, fearing traffic, crowding, perceived changes to neighborhood character, or potential impacts on their property values.
So how do we potentially overcome that resistance? Are there policy ideas?
There are some interesting ideas emerging. One mentioned in the sources is tax increment local transfer, sometimes called TILTs.
How would that work?
The core problem with NIMBYism is that current residents often feel they bear all the perceived costs of new dense development nearby. The construction noise, the extra traffic, the strain on local schools, while the increased tax revenue generated by that new development mostly flows to the city's general fund, benefiting everyone else.
So Tilties try to change that incentive structure.
Yes. The idea is to allow the residents living immediately around a new development project to directly share in the benefits. A portion of the increased property tax revenue, the tax increment, generated by the new project would be transferred directly back to the nearby homeowners, perhaps as property tax rebates or direct cash payments.
So you're basically trying to financially co-opt the opposition.
Essentially, yes. By giving neighbors a direct financial stake in the success of new development, you potentially turn opponents into supporters, or at least neutralize their opposition. It tries to align incentives toward allowing more density.
Interesting approach. Okay, finally, let's pivot to the massive impact of technology on real estate, the whole world of prop tech.
Prop tech, or property technology, is a really broad term, basically covering all the ways technology is innovating and disrupting the real estate industry, from how we find and finance properties to how we manage them, even how buildings and cities are designed and operated.
What are some key examples of how it's changing things on the ground?
Well, for agents and brokers, we're seeing incredibly sophisticated customer relationship management, CRM, systems. These go way beyond just storing contact info. They use AI and data analytics to help agents deliver highly personalized marketing, predict client needs, and manage relationships much more efficiently.
And for buyers and tenants.
The experience of viewing properties is being revolutionized. Virtual reality, VR, and augmented reality, AR, allow people to take immersive, realistic tours of properties from anywhere in the world.
So you could walk through a house in another city without ever leaving your living room.
Exactly. This makes the selection process much faster and potentially better informed, reducing the need for costly and time-consuming physical visits, especially early in the search.
What about valuation? Is technology changing appraisals?
Significantly. While traditional appraisals are still important, especially for lending, we now have advanced algorithms and automated valuation models, AVMs, that can estimate property values with remarkable speed and often surprising accuracy. They analyze vast amounts of data, historical sales, market trends, neighborhood characteristics, economic indicators far faster than any human could.
So providing quicker estimates and trend analysis?
Yes, helping investors and agents track market movements almost in real time.
Now, for the big players, the large investment firms, the REITs, one of their huge challenges isn't necessarily a lack of data, but getting all their different data sources to talk to each other, right?
Data tends to be siloed.
That's a major pain point. They might have financial data in one system, property management data in another, market research from third parties and spreadsheets, maybe utility consumption data somewhere else. It's all disconnected.
And that's where dedicated data platforms come in. The sources mentioned Share as an example. Right. Platforms like Share aim to solve this exact problem. Their goal is to ingest and connect all these disparate internal and external data sources, everything from your own portfolio performance and lease information to public records, demographic trends, even things like foot traffic patterns or weather data.
To create what they call a single source of truth.
Exactly. By integrating everything into one platform and standardizing the data, they provide a unified, comprehensive view of the market and the portfolio.
And the benefit is?
Speed and smarter decisions. Instead of analysts spending weeks manually gathering, cleaning, and trying to reconcile data from a dozen different places, the platform can provide actionable insights much more quickly.
So investors can spot opportunities faster, evaluate risks more accurately, and deploy capital with greater confidence and efficiency.
Precisely. In a competitive market, that ability to analyze faster and act decisively based on integrated data provides a significant edge. It saves enormous amounts of time and resources previously wasted just wrangling data. Hashtag tag outro. So we've really covered a massive amount of ground today, haven't we?
We definitely have. We started deep in the weeds, the specific math of calculating net operating income, the absolute necessity of having a debt coverage ratio comfortably above 1.0, ideally 1.2 or higher.
hmm Then we move through those critical financial and tax tools, understanding adjusted basis when you sell, the incredible power of depreciation, and especially the wealth compounding engine of the 1031 exchange.
Right, while also flagging the pitfalls like the strict 1031 deadlines and that UDFI tax trap if you use leverage in a self-directed IRA.
And we anchored all that financial strategy in the need for execution discipline habits, clear communication using frameworks like StoryBrand, understanding sales psychology like reciprocity, and building relationships based on, like trust and flow.
And then we zoomed way, way out. We looked at the deep historical roots of today's urban landscape, how government policies like FHA redlining and exclusionary zoning actively shaped segregation and influenced wealth building for generations.
Yeah, understanding the history is crucial context for any market you operate in today. And we touched on the ongoing urban shifts, the great inversion, the challenges of NIMBYism, and how technology, prop tech, is rapidly transforming everything from finding deals to managing data.
So if there's one overarching lesson from weaving all these threads together,
I think it's that true, sustainable success in real estate demands this duality. You absolutely have to master the granular micro-level details, the contract clauses, the due diligence math, the legal and tax nuances.
but that's not enough.
No, you also need to maintain a clear, sophisticated understanding of the macro forces at play, the urban dynamics, the historical context, the technological shifts, the policy environment, because those forces ultimately shape the long-term value and risk of your investments. You need both the microscope and the telescope.
Well put. Which brings us perfectly to our final provocative thought for you, the listener, to maybe chew on after this deep dive. Our sources confirm something we intuitively know. The length of time you hold an investment plays a huge role in the actual risk you assume. Longer horizons tend to smooth out volatility. Now, if you combine that with what we just discussed, the deep, multi-decade impact of government efforts to shape communities through deliberate policy, here's the question.
What long-term trend thinking, 20 years out or more, perhaps demographic, perhaps technological, maybe environmental, are you least prepared for in your current real estate investment strategy?
Is it the potential impact of climate change on insurance costs and property viability in certain regions? Is it the rise of remote work permanently altering demand for office space or residential locations? Is it automation displacing a key industry in your target city? What future risk rooted in these big, slow-moving trends have you not fully accounted for?
And more importantly, what system, what process, what piece of knowledge do you need to start building today to mitigate that future risk and ensure your strategy remains resilient?
Something to think about as you integrate all the knowledge from today's deep dive.